Ladies and gentlemen, a very good afternoon to you all. My name is Silvana Shah, and our paper today is titled An Empirical Study on Determinants of Indonesia's Firm Capital Structures. Before getting on to the main content of my paper, I would like to run you through my presentation. I will first speak to you and give an introduction about my background details. I will also look at empirical literature, both international and local. And I will also speak to you about the contribution of my study to existing of body knowledge. And I'll speak on the research methodology data collection aspects. And I also give you the sample pilot analysis and result. And I will bringing you some real world scenario. How was my study impact on determinant of Indonesian firm capital structures? One of companies' financial policy phenomena is capital structures. Companies have a large portion of the debt in the capital structure will put a heavy burden on company if management is unable to manage it properly. However, debt in capital structures is still necessary when the capital lacks funds to finance its operations and investment, especially in times of high market growth. The use of leverage has important implications and provides benefit to the company. Among them are the benefit of paying interest, debt holder obtaining a definite return where through financial leverage it is possible that earning per share will increase and control of the company operation by existing shareholder is unchanged. Companies that have a large portion debt in the capital structure will put in a heavy burden of the company if management is unable to manage it properly. The trade-off theory derived from theory, which suggests that companies choose the optimal capital structure of debt and equity cost benefit, and the pecking order theory, which assumes that there is or is no target leverage company using debt in their internal funds are not sufficient. In the study, with differences in result of a research on the determinant of capital structures, the author is interested in conducting research on the determinants of capital structure firms listed on Indonesian stock exchange. And the purpose of this study is to obtain empirical evidence regarding the influence of profitability, growth, opportunities, and firm size on the capital structures. Proceed by leverage. And now we go into theoretical empirical review. The capital structure, according to Sartone, is a balance and amount of permanent short-term debt, long-term debt, preferred share, and ordinary share in a company. And an optimal capital structure is a capital structure that can be minimized that average cost of capital. Another theory was put forward by Myers, which stated that companies favor internal financing. If external financing is required, the company will issue the safest security first. It is different from trade-off theory, where the best decision is the moderate decision by considering both financing instruments. According to Brigham, debt has advantage in interest costs that affects taxable income, so that the debt becomes lower. So ladies and gentlemen, these are 9 study of literature that analyze the capital structures, started from Vijaya and Hadianto, has found that the structure of assets and the size of company have no effect on the capital structures. Then liquidity was found to negatively affect to capital structure and support pecking order theory, while profitability was found to have positive effects on the capital structures. And then Rohim, he found that profitability negatively affects the capital structures. And then Aditya, company size and sales growth had a significant positive influence on the capital structure. Mean liquidity and profitability variables have a significant negative influence on the capital structures. And then Margaret and Sari, the size of the company has negative influence on the capital structures. And then Prabhan, Sari, and Kusuma, partially the size of the company has a positive influence of the capital structure, while business risk has negative influence on the capital structures. And then Nasruddin, company size, profitability, sales growth, and risk had significant positive influence on the debt ratio, and the risk variable had a significant negative relationship with the debt ratio, and the company size, company growth, and profitability have a positive effects on the capital structures, while business risk negatively affects capital structures, and etc. Now we go into theoretical, still in theoretical and empirical review. From the effect of firm size and capital structures, that research conducted by Sartono and Srihanto, Aditya, Saidi and Harjanti and Tadenli, that the size of the company has a positive effect on the capital structure, and another was shown by Margareta Ansari and Nasruddin, who found evidence that company size had negative influence in the capital structure, that from the following hypothesis on the logical relationship and empirical evidence described in the preceding discussion. In this research, we took hypothesis 1 as firm size has a positive effect on capital structures. And then the effect of growth opportunity regarding according the research from the Setiawan and Laksito, Sartono and Aditya urges that companies with high growth rates tend to use outside sources of fund. Then from the following hypothesis, the following research, we took hypothesis 2 as growth opportunity has a positive effects on capital structures. And now we go to hypothesis 3 from the research by Setiawan Laksito, Sartono, and Sukarno. Shows evidence that the company with a high growth rates tend to use outside sources, so that the higher their capital structure. So we took hypothesis third hypothesis as profitability has negative effects on capital structures. And now we go into method of research. The subject of this research are Indonesian firm listed on the Indonesian Stock Exchange in 2022, and the sampling technique used propositive sampling and technique data analysis using ordinary least square. Propositive sampling was used in this study, and the following criteria were used. The first criteria is firms that present financial report on a regular and consistent basis. Second, firms whose stock is always actively traded on the stock exchange. The third criteria, based on the firm size, it is divided into two, namely small firm with total asset less than 1 billion and a large firm with a total asset more than 1 billion. Based on predetermined criteria, there could be as many 339 firm sample that meet the criteria, and ordinary least square regression is used as statistical method. The dependent variables is capital structures proxied by leverage. The independent variables include profitability, firm size, and growth opportunity. And then we go into formulation of measurement variables. The firm size is formulated by logarithm natural total asset, and then profitability, EBITDA divided by total asset, and then growth, market value, equity shares plus book value total asset minus book value net worth. divided by total asset, and then leverage, long-term debt divided by total assets. Now we're going to research result and discussion. From the regression models, we have a capital structure equal to minus 0.3.07 minus 0.071 profitability plus 0.02 size minus 0.001 growth. We have a significant value for company size that it can be stated the company size has positively affects on the capital structures. The size company is proven to have important role and determine the choice of capital structure that will be used by company, and large company usually have better reputation in debt market and face lower information constraint when making loans, making it easier to obtain capital in market compared to small companies. Accordingly, the larger of the size of company, more it has greater level of debt. These results are consistent with the research of Prabansari and Kusuma and etc. that company size has a positive of significant effect on the company capital structures, and the study support the trade-off theory, which states that large companies tend to use external fund or debt. And then result number 2, the significant value of sales growth is 0. It can be stated that the partially sales growth has negative effects on the capital structures. So that this suggests that the higher of the growth rate of the company, the higher its debt use does not apply this study. The existence of the high and low sales growth rate does not affect the selection of the company. The company in this study is due to the factor of measuring indicators. This is because the company rate for the company is measured using sales growth indicator, while the company growth rate cannot be measured definitely and cannot be seen only based on the sales growth. And then now we go on the third hypothesis, that the profitability has a significant negative influence on the capital structures. The higher of profit obtained by a company, the smaller the need of funds, especially from investors, both of short and long term. And company with a high level of profitability tend to use internal funds for their operating and investment purposes. And company with a greater level of profit have larger internal funding sources and have a need to finance investment through smaller external funding due to the high rate of return that funds can be obtained with from retained earning. The result of the study support the pecking order theory, which states that a company will first use retained earnings as investment funds and then switch to the new to new bonds and equity only when necessary. And then now we go into closing. Based on the research above, it can be simulated. First, the result of a simultaneous regression testing show the influence between the variables of the company size, profitability, and sales growth on the capital structures of the company of Indonesian Stock Exchange. And second, the test result partially show the size of company partially has the significant positive influence on the capital structures. The sales growth has negative effects. Positively effects on the capital structure is not accepted, and profitability coefficient of profitability negatively affects of capital structures. Third, the result of the value of the variation in changes in capital structure can be explained is the result of the value of coefficient and determinant of adjusted R square of 0.269 shows that 26.9% of the variation is changes in capital structure can be explained by variation in changes in company size, profitability, and sales growth, while 73.1% of variation is changes in capital structure are described by variation in other variables outside the research models. And then we go on to managerial implication and future agenda, research agenda. This study has limitation, including a limited number of samples of only 339 companies in year 2020. There are normality and heteroscedasticities issue in this model, so need to be solved as for suggestion that can be submitted by the author from the results of research that has been carried out. For a fund manager who will carry out funding plans, they should remain more cautious about factors that may affect the capital structures. The use of variation in other variables that may affect the capital structure, for example, ownership structure and industry type. Use the different proxies that may reflect the level of risk and growth of companies. Thank you.